My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to a special West Coast edition of Mad Money. Welcome to Cramerica. To make friends, I'm just trying to make you a little money. My job, not just to entertain, but to explain. So call me, 1-800-743-CNBC. Tweet Jim Cramer. Everybody on Wall Street loves to be a contrarian, which is why so many commentators keep trying to minimize the impact of a half-point rate cut. Not me. No matter what common sense dictates, there are always people who think they know better than common sense, and they don't. There are so few advantages to age, I gotta tell you. I mean, I can no longer jump up and down through a full Pink song at a Benioff hospital benefit like the one we went to last night, to name just one age-related indignity. But by just showing up, I knew better than the posers who told us that a 50 basis point cut was bad news because it was somehow a sign of panic. Funny thing, while these critics were polluting your minds as so many tanneries polluted the old Gowanus Canal to the point where it was flammable, the stock market exploded today. Dow gaining 522 points, S&P surging 1.7%, NASDAQ pole vaulting 2.5%. I got to tell you, it was a thing of beauty. The bears initially had their way with the markets, once again distorting a view immediately after the announcement at 2 p.m. yesterday. They fooled enough people to start blowing out of stocks in a frenzy, especially tech, as if somehow those are the stocks that always get hit on a rate cut. That's just not even true. There were also people who panicked, and then there were people who thought that the Fed panicked. Look, they're easily swayed by the market's action. And then just something commentator after commentator came on air, our air, everyone else, and just echoed this negative narrative out of nowhere. After all, who wants to go against the tide and question why sellers are streaming for the exits? They're going to steamroll you. You don't want to be in the way of that. You know what? That's really how it happens. That's how the afternoon aftermath of a rate cut, not a hike, but a cut, snowballs into a giant avalanche of people who've been instantly brainwashed into thinking that a 50 basis point easing is somehow bad news. That's what we saw yesterday after 2 o'clock. That analysis was always absurd, just pure foolishness, which is why the market came roaring back today when it had a little breathing time. First, you need to know that a rate cut is never bad for stocks, as long as it's telegraphed. A large rate cut, as long as it's communicated to the media with plenty of time in a considered way, is also acceptable. This time we were set up perfectly by the Fed. They spent about a week laying the groundwork for a double rate cut for the actual meeting, including perhaps sharing some thoughts with one of the most reputable reporters at the Wall Street Journal. They made it clear that they're doing this because rates are now too high versus the declining rate of inflation, not because they're worried about some sudden softening in the economy and big job losses. We don't have those. See, there was nothing really negative lurking. It's just it was the right thing for the Fed to do. Now, that gave money managers some time to reposition before the Fed meeting. Some did, and obviously some didn't. So what was the rational reaction when you read that we're likely to get a half-point cut, not a quarter-point one? Let's go over it. First, when you get rate cuts, that's official confirmation that you are no longer fighting the Fed when you own or buy stocks. The late, great Marty Swag, the best pure keeper of events and the reaction to them in the stock market, always had one really simple precept: don't fight the Fed. When they're raising rates and turning the liquidity spigot off, you got to be more negative. You just have to be. But when they're cutting rates and pumping more money into the system, look, when it comes to the stock market, we're under the reverse Biggie Smalls dictum. More money, fewer problems. Second, when you get a double rate cut, meaning a 50 basis point monster, well, that's going to make tens of billions of dollars come into the stock market from the sidelines. The sidelines have been so lucrative for so long that people in money funds have been coveting their dollars. Sure, there are plenty of folks sitting in 2 to 3 year CDs or treasuries who can't easily cash out. But if you are in an easily accessible money fund, you can see rates are going lower now, right? Which is all the more incentive to put your cash and say, I don't know, how about a dividend stock with a high yield? Got to do it fast because pretty soon the high yielders will rally to the point where they're just mid-yielders. Third, no matter how smart they sound, the people who come on television to argue that the Fed's actions don't matter because, say, the national debt is too big, here's what those people are being: unhelpful. These people are polemicists. They have nothing to do with helping you make money. It's not important to them. You're not important to them. They're speaking to the billionaire class. They crowded out you a long time ago. Remember, we do have all sorts of audiences. Fourth, the winners in an easing cycle are varied and exciting. The losers are obvious and must be avoided. From the moment the Journal reported that there could be a 50 basis point cut, the swatch of what can go higher expanded dramatically. 25 points would have been truly beneficial for home builders if they would just stand to start building a lot more homes. That's something that they've been reluctant to do because rates are still too high. But 50 basis points means lower mortgages for certain and therefore more affordable homes. And it goes way beyond the home builders now. With a double rate cut, the winner's circle includes the stocks with powerful trends that nevertheless have been beaten up. Look, I'm out of Dreamforce. We were at the Salesforce extravaganza yesterday. That was all about AI. Okay, and CEO Mark Benioff has an ingenious plan to help you, the individual, benefit from AI, not just the big enterprises. Yet the stock got hit yesterday, got hit hard. Well, today what happened? People came to their senses. It rallied 13 points. We talked to Lisa Su, the CEO of AMD here, and she has more business than she can handle. Her stock soared more than 8 points. We listened to Jensen Huang, CEO of NVIDIA, talk about how hard it is to ration his chips because they can't make them fast enough to meet the demand. Yet you couldn't give the stock away yesterday. Today it roared 4.5 points, although at one point it was up 6. You can watch Taiwan Semiconductor up more than that. They are linked at the hip. Apple's iPhone 16 was pronounced stillborn by some outfit. I don't even remember their name, even though it's not officially on sale until the end of the week. That was the best opportunity of all, with the stock gaining an astounding $8. I'll give you a little more on Apple later. Of course, at this stage in the cutting cycle, you have to let go of your recession-resistant consumer packaged goods stocks. I told you that the Procter wouldn't work anymore. Colgate ain't working. You got to inject the utilities. They've been real good performers. Now they'll be poor performers. They had the run. It was real nice. They were terrific bond market equivalents as long as their higher yields lasted. But now Wall Street no longer has an appetite for sure stocks that don't take any risk and don't go up a lot then. Okay, that was your game plan. I gave it to you several times. It's the backdrop that's worked over the course of my entire career. If you have any doubt about the playbook, go back and read the part of a rate cut in Confessions of a Street Addict, my autobiography, when I realized how powerful a rate cut could be. It made me look foolish. It's a fun read, though. The Fed's power is immense, and with a 50 basis point cut, they rolled out the big guns. If you want to fight that, if you want to listen to people who babble about the national debt, hey, that's fine. Knock yourself out. The business isn't for everyone. But if you're trying to make money, which I think is really important, you got to accept the fact that the Fed pulled out the bazooka and you can't afford to stand in front of it. You want to be behind it. Bottom line, there'll be more rate cuts, and there'll be more rate cuts, and even more rate cuts. And there'll be more talk about how our country's in trouble, the Fed can't do anything, and nothing matters, and everything must be wrong. But as long as the Fed keeps staging its cuts perfectly, like they did with this one, then your job is to know when you're snowed and bring a down parka when you're snowed with some noise-canceling AirPods. The new ones are supposed to be great. Tune out the naysayers, and you'll be just fine, because the Fed is now your friend. That's all that really matters. Hey, I think we should take calls. Let's go to Rich in New Jersey. Rich.
Hey, Jim, it's Rich from Belmont, New Jersey at the Jersey Shore, hanging out at Bar A. How are you?
No, I want you to get out of the bar and go to La Dolce Vita and tell Nick I said hi and have the meatball.
Absolutely. I was there last week with the veal chop, the best in the city.
That is a great veal chop. I wear a bib when I use the veal chop. Do you ever have the clam sauce, the white clam sauce?
Absolutely.
All right. I just want to be sure. Now we can go to work. What's up?
So I've been buying this company stock for the past 3 years. It's a diversified company. Got a great CEO. Been profitable for the past 3 months, 3 quarters. But it's been frustrating. It's a hated stock, very well shorted. Banks hate it because it's competition.
Okay.
With a great CEO with Anthony Noto. What do you think of SoFi?
Okay, I think now the rates are coming down. You're going to see that actually it's more of a technology stock, but it's going to go higher. And I'm so glad that you know how to eat when you're down at the Jersey Shore. I'm out of Long Island, and the food, forget about it. I like Jersey. Now, as long as the Fed keeps staging its cuts perfectly like they did with this one, then your job is just to tune out the naysayers and you'll be just fine. Oh, man, tonight, fresh off the Fed's cut, I'm giving you a data-driven set of potential winners in this tape. Don't miss my breakdown of some names that you want to take a pen and paper out. Plus, exactly 2 months after a massive tech outage, I'm talking to CrowdStrike CEO from the company's conference to get a sense of where the stock could head and a new ally that he might have. And as more growth on the table for Darden Restaurants, I'm eyeing the earnings release from today's best performing stock in the S&P 500. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Finally, the market's behaving like you expect when the Fed is your friend. And as I told you at the top of the show, believe me, there are few things more friendly than a 50 basis point rate cut. I've told you over and over again that there are discrete phases in the business cycle. When the Fed is your enemy, when it's raising interest rates, you want to stick with the recession-proof stocks of companies that can produce consistent earnings even in a slowdown. Then once the Fed's done tightening and we start seeing signs of impending rate cuts, you need to load up on the cyclicals, the companies that can see massive earnings growth when the economy accelerates. But what works best once the rate cuts have already started? Yesterday, Sarahman and the CNBC Pro team ran an analysis of which stocks in the S&P 500 tend to perform best over the 3 months after the Fed starts easing. I like this piece. Going back to 1984, they identified 10 stocks with the highest median performance after the first rate cut. And it is really a surprising list. Get this. Western Digital, Lam Research, United Health Group, Expeditors International, Apple, Kroger, Textron, Franklin Resources, Amgen, and Target. Surprising amount of tech in there, too. Surprising amount of healthcare. So let's go through them one by one because I think it's important to learn from history, whether or not that history ends up being repeated or not. First, Western Dig is up over 20% on average in the 3 months following the first rate cut. This maker of hard drives and solid-state drives, basically storage for your phone or your PC, has historically been, sadly, a giant value trap. Just a trap. Right now, we're seeing an uptick in demand for storage as part of the AI data center theme. But if you want to bet on that, you know what? Why don't you go with the down-and-out Micron? It's much better operators. Pull back dramatically. Reports real soon. A lot of people have written it off. Second, Lam Research is a key semiconductor capital equipment maker. Right now, they're being suppressed by a lack of Chinese orders, not to mention Intel slowing its European manufacturing plants in order to preserve its balance sheet. Wise. If not for those issues, I think it'd be a great buy right now. But given that the industry's got problems, I say let it come in even more, but Lam is the best in the group. Third, United Health. Unusual rate cut winner. In theory, it should be more of a slowdown stock. But empirically, it's done very well when the Fed starts cutting rates. UNH is a terrific operator that's been pulling away from the rest of the managed care space, but I wouldn't recommend buying it right here unless you think the Fed's desperately cutting rates because the economy's falling apart. Then you buy UNH. I don't see that happening. Fourth is Expeditors International of Washington. Now, this is a pure logistics play, but in my opinion, it's a poor man's FedEx and will trade off because FedEx tonight is tumbling in after-hours trading after reporting kind of a bad miss and cutting its full-year forecast. Bummer. Right now, ocean freight rates are high. Yemen keeps disrupting shipping in the Red Sea. But if we ever get some stability in the Middle East that goes, it goes away, maybe I can make a case for Expeditors. Hard to recommend, though. Fifth, Cramer fave Apple. I always say own it, don't trade it, and I'm extra adamant about that position after what we heard from T-Mobile's Mike Sievert yesterday. Contrary to what the Bears have been telling you, Sievert says sales of the new iPhone are going just great. I want you to listen to what he told me last night.
This is another year of great phone introductions.
You're telling me the first week's been good for you?
The first week was better than last year. And so not only good, but better than last year. And people are buying Pros, they're buying Maxes, so they're buying up the food chain, and they're buying at a greater rate than last year. Now, what's interesting is we may actually see that this is better than last year to a slightly greater extent, because I have a feeling this cycle will be lengthened a little.
Man, I love truth. Truth's good. Now, I'll have more on Apple later. You just need to know that this is our number one name, despite endless sources trying to shake you out of this one. This is still a technological marvel, for heaven's sake. Sixth, there's Kroger. Now, I've been amazed at their ability to run a tight ship, even while fighting with the FTC to get that Albertsons merger done. Last week, Kroger reported a real good quarter, but with Albertsons deal languishing, I think it puts a lid on the stock. That is so unfortunate, because I like it very much. Seventh best performer when the Fed starts using Textron. Huh? intriguing industrial. They got autos, they got defense, they got business jets, think Cessna. I think it could work now if the Fed's cutting rates, but keep in mind, Textron will get clobbered if the economy is truly in much worse shape than we think. Number 8 is Franklin Templeton. It's an asset management story, but one of its subsidiaries is being investigated by both the SEC and the Justice Department. Suboptimal. Last month, its longtime chief investment officer, who managed some of the largest bond funds in America, took a leave of absence after getting hit with a Wells notice from the SEC. In the end, it's rarely a good idea to own stock in a company that's under investigation, especially when the Justice Department's involved, too. I don't think you can touch this one. I think this is what the kids mean when they say that the vibe is off, something that doesn't really feel right. To me, vibe off means that I've got it on ringer. 9th, there's Amgen, which could be good this time, but I hesitate to recommend a drug stock right before a presidential election. Democrats are always tough on drug prices, and frankly, neither candidate loves this industry. Plus, if you want a drug stock, you know what? At this point, just go for a big dividend. It comes a little more enticing as rates come down. Finally, there's Target. Now, this one makes a ton of sense to me. Of course, Target wins when the Fed starts easing. On top of that, it's got a terrific turnaround story. The company just reported its first positive same-store sales growth since 2022, driven by higher traffic, not higher prices. Thank you, Brian Cornell. I think Target's doing a lot of things right, controlling costs, growing margins, stopping theft, and cutting prices to bring back customers. On top of that, they're taking share on the digital side. When it comes to retail, I think there's room for Target, along with Amazon, Walmart, and Costco, along my other favorites. Plus, it's got a 3% yield. So here's the bottom line. Now that the Fed started cutting rates with a bang, you need to think about what kind of stocks will work best in what I consider to be a new regime. Our friends at CNBC Pro got you started with the 10 stocks that done best during the first 3 months after rate cut, going back to 84. But when you go through their current circumstances, the only ones I can fully endorse are Apple, Target, and Textron in that order. I feel in a call mood. Let's talk to Lane in New York. Lane.
Hey, the doctor of brainology, Jimmy, baby, what's going on?
Not much. What's shaking with you, partner?
Hey, let me throw something at you. I was talking to one of my buddies. I'm a mailman. So
okay.
I have the UPS stock. So by what I hear, that is an up and down stock. So they are just landed a huge contract by the USPS to deliver all the mail. So is that a good growth stock, or should I, even though with that happening, should I go to FedEx or another?
Okay, here's the problem. FedEx reported a number that is weaker today. We've got to see how UPS acts off that. UPS has been holding well. Why? Because it's got a 5% yield. And I think that's what's really going for it. Pay 5% while you wait for a turnaround, but we don't have a turnaround in sight. Let's see what FedEx has to say, and we'll know more then. Let's go to Richard in Michigan. Richard!
Oh, that's nice. Yeah, Richard from Michigan. Hope you're having a great time in San Francisco, Mr. Cramer.
I love it here. I love it here. Frankly, it's like, it's sensational. I just love it. What's going on?
Before, love it. I'm a charter member in an investing club, and
thank you.
I'm at an age where I'm trying to reduce volatility and add some diversification in my portfolio. I have a stock that I've never been in the industry before. It has a PE of 10, forward PE of 10.6. With the half-point reduction in Fed funds and mortgage rates trending lower, what's your feeling about a trade-up stock like Toll Brothers?
Okay, I like Toll, and everybody knows I like Toll. I interviewed Doug Yearley not that long ago, a week ago. I think you're doing well, but Lennar reported tonight, and people don't like Lennar, so Toll will probably be down. We're going to have to take a hard look at how low it goes, but I do like Toll, and I do like Toll more than Lennar. All right, now that the Fed started this cutting cycle, I think Apple, Target, and Textron, TXT, are the stocks that will benefit the most. I can't believe I just said something good about Textron. It's been a decade, but I have to endorse it. Much more Mad Money head from San Francisco. Darden Restaurants popped over 8% today after earnings. I'm thinking the important new collaboration helps see what's cooking there. Hey, by the way, their steak place has great Bloody Marys. And T-Mobile, unsolicited but still good advice. And T-Mobile's top brass revealed the sales that he's been seeing for the new iPhone 16 models. We got to take an even closer look at what people try to do to get you out of Apple stock. I don't think they like you. But first, don't miss my exclusive with CEO of CrowdStrike, who's now buddying with Microsoft. Anything can happen, so stay with Cramer.
without further ado, I have my special guest, which I will announce here, which I know many of you would think would be impossible 2 months ago. But it's a great pleasure to introduce Satya Nadella from Microsoft, who is joining us.
All right, you just did see something amazing. That's Satya Nadella from Microsoft speaking at a CrowdStrike Falcon conference with George Kurtz. He's CrowdStrike CEO. These two execs have at times been pretty much at odds, but it doesn't seem like that now. In fact, I thought this was kind of a wowza moment. The stock's been on a roll since that terrible outage July 19th that crushed the stock. It's rallied 38% from its low of 200 and change in early August to $277 today. You know, I said that the bottom was 230. It's still down more than 100 from where it was pre-outage, though. Now, I'm a big believer in this one, but don't take it from me. Let's speak to the man himself, George Kurtz, the co-founder and CEO of CrowdStrike, to get a better read on the situation. Mr. Kurtz, welcome back to Mad Money.
Great to be here with you, Jim.
George, I think I'm one of the people you addressed when you introduced Mr. Nadella. I'm one who's incredulous, didn't think this could happen. How did you two get to the point where you actually appeared at your conference?
Well, Jim, you have to step back. July 19th happened, and really what happened is two companies came together and put customers and security first. And security is bigger than any two companies in the industry. But I think it really reinforced what customers want, and that is collaboration at the highest levels to make sure that customers are protected, customers are resilient. And we worked very closely in the early hours and weeks post that incident, and it really demonstrated the collaboration that needs to take place in security. And I think what you've seen is two companies coming together to make the industry more resilient and better for customers. And Satya and Microsoft were gracious enough to talk at our conference, and I got to tell you, it was hit by all of our customers.
Now, I just want to drill down a little bit on this because I happen to have done a lot of work on this, and some of it is the suggestion of you about some of the shortcomings that Microsoft has. I even had someone on from Microsoft to say, look, Jim, maybe you aren't seeing the full picture. But, George, you have been a critic, and you have pointed me to even congressional testimony that would indicate that perhaps Microsoft has not done the best job when it comes to cybersecurity.
Well, as I said, Jim, in this particular case, we've come together because it was for the betterment of customers. And if you think about their ecosystem, it's an open ecosystem that needs companies like CrowdStrike and others to be able to keep companies secure and resilient. And I think that's what you've seen is a new page turned, and the collaboration, I think, is good for customers. We're still going to compete in the marketplace, but ultimately, we're working towards making better products for customers to help protect them.
That makes a ton of sense to me, and it's great to see you guys work together because nobody wants what happened in July to happen again. Now, I did see some numbers from your conference that were pretty definitive. 98% gross retention. Things that happened after that day usually start with tough conversations, but then go to "We love CrowdStrike." You've continued to make it so people who you would have thought might have gone elsewhere are actually doing more business with you than before the incident.
That's right, Jim. If you look at this conference, we've got 6,000 CrowdStrike protectors. Those are our customers. We call them protectors. We've got over 2,300 organizations represented. We've got over 100 partners, and we all came together, and there was a lot of excitement. And the meetings took place, the electricity, the learning, and it was a very common theme. You know, we thanked customers, and they thanked us. They thanked us for all the times that we were there for them, that we helped save them, and we helped stop the breach. And in fact, I had many customers come up to us and say, the transparency, the accountability, what you did in the early hours, the team that we put in place across the globe to make sure customers were up and running was unparalleled. And customers remember that. They remember that in a time of partnership and in tough times and in good times. And I think that's going to serve us really well.
I know you're a person not necessarily you don't use a lot of sleep, and we know that even from your on-road activities. But I do want to say, when you say that you literally met and touched thousands of customers, you really did touch thousands of customers personally, didn't you?
I did. It was nonstop. Like many folks, we're working around the clock, and we touch customers on Zoom. We met with large ISAC organizations. These are these industry sector groups, and literally hit thousands of customers. I'm heading back on the road in person to meet a whole bunch coming up here in the next couple of weeks. So it really is about meeting the customer, explaining what happened, obviously making sure it doesn't happen again, talking through the changes that we've made and really focusing on moving forward. And that's what customers have told us. They want to move forward. They love our technology. In fact, I had several customers, tell me they will only work in an organization that has CrowdStrike technology. And I think that gives you an idea of the loyalty that we've been able to generate with customers over the past 10 years.
Well, okay, but you've told me that the bad guys are very clever. They seem to be targeting actual companies to do cybersecurity. I'm pulling up with Okta, a really fine firm that I've known since basically they started. Tomorrow, I think they do a good job. They were hit. Fortinet's a company I've had on so many times. They've been hit. I mean, is this the new thing to go after the sheriffs?
The security industry has always been under attack. It's been under attack for the last 30 years. That's not going to change. I think when you look at the landscape, it really underscores how determined these adversaries are. And one of the areas, and you and I have talked about this for a long time, is identity-based attacks, social engineering pieces. So you've got a lot of technologies in place, but you see users trying to be helpful, but just giving out their credentials and having these sort of breaches, which is one of the reasons why our identity protection solution has done so well in the market, because it can identify these identity-based attacks and prevent those sort of attacks from taking place and prevent lateral movement and data theft. So again, just one piece of the Falcon platform and one of the really strong emerging businesses that I continue to talk about.
Well, let's talk about identity-based. There are a bunch of companies that tell me that they're best at identity-based, and I find it hard to figure out who's the best, and I just kind of default and say, well, maybe what I just want is a soup to nuts. I just want one company that handles both. Is that a better ROI, so to speak, or do you say to people, listen, maybe you should use somebody else for identity and use this, and we'll handle other aspects? What is the selling proposition?
Well, the selling proposition for CrowdStrike really is consolidation on our platform in the areas that we focus on. And I think what's important to realize is not one security company can do it all. It's a very complex area, and there's lots of technologies to secure, and the technology curve continues to get complex over time dramatically. So from my standpoint, we focus on really what we're good at, endpoint protection, data ingestion, and then the Falcon platform has really allowed us to solve many more use cases beyond just endpoint protection, things like next generation SIEM, cloud security, identity. And those are the areas. We want to be the best in those areas, and then we want to partner with others that take care of their own domain. And I think that's what's important. Customers want best of platform, and they want to put the best of platform together and have security outcomes of stopping breaches, lowering cost, and driving complexity out of their organizations.
All right, I don't want to necessarily call what you and Satya did a detente, but is it possible that there are holes in Microsoft's cybersecurity work that you can fill, and perhaps they see some things that George Kurtz could learn about CrowdStrike, making it so you offer together the best product for customers?
Well, ultimately, it's an ecosystem. We have to work together, right? We're protecting, a big part of our base is protecting Windows, and they're providing the ecosystem. So really, it's in everyone's best interest to continue to work together. And we spent some time. I actually went to Redmond. There was a full one-day workshop with not only myself, but other security companies around the globe. And we talked to Microsoft about what we need as security companies to build safer and more resilient and better technology. And they've committed to keeping the ecosystem and the kernel open, as well as being able to provide an abstraction layer that allows all the security companies to be able to operate and do what we do. So it's very encouraging. And as I said, it's turning a new page. We're still going to compete in the marketplace, which is fine. But the collaboration, I think, it really makes it good for our joint customers.
All right, one last thing. When I think about how you have a $10 billion ARR with very big, very, very bold target, I think that maybe it's because you're resilient by design, and your customers know that CrowdStrike is resilient by design. How do you feel about that as being maybe the hallmark of what you offer?
That's right. Resilient by design is stopping breaches and making sure that we can drive cost and complexity out of the organizations and do it in a way that enables them to be resilient in their own business. And one of the things that I talked about in my keynote at this event was resilient by design, right? Having that as a foundational element within what we do at CrowdStrike, but also enabling our customers to make it foundational to their own business and make it adaptable. You have to adapt and understand the industries they're in and you have to create software and protections to protect them specifically in their industries and allow them to operate in a resilient fashion. And the last piece is continuous, and that's continuously learning, not only about the attacks, but continuously learning and strengthening the collective system to provide resiliency across the entire ecosystem and for all of our customers.
Well, George, I think one day we'll look back, probably not even just in a couple of years, and you will replace a lot of the use cases you read at business school about what to do in a crisis. Because I think what you do in a crisis is you get out there and you meet everyone that is humanly possible. Don't hide. Don't get down into the bunker. Too many go into the bunker. George Kurtz is not a bunker guy. George, co-founder, president, and CEO of CrowdStrike, thanks for coming on Mad Money.
Thank you, Jim.
Absolutely. Mad Money's back after the break.
Coming up, your table is ready. Cramer orders up an overview of Darden restaurants. Next.
You know what was the best performing stock in the S&P 500 today? Darden Restaurants, the parent company of Olive Garden, Longhorn Steakhouse, Capital Grille, Ruth's Chris Steakhouse, Yard House, and a couple other restaurant chains. The stock jumped 8% after the company reported this morning. You know what's really crazy about it? The earnings weren't even that good. I winced when I saw the numbers cross the wire this morning. Darden same-store sales were down 1.1%. Wall Street was looking for a smaller 0.3% decline. Olive Garden, which is nearly half the company, saw same-store sales down 2.9%. That's a whole percentage point worse than expected. The fine dining segment, Capital Grille, Ruth's Chris, Eddie V's, they had some same-store sales were down 6%. The analysts didn't even think they'd be down 1%. Their smaller concepts were down 1.8%, also much worse than expected. Only Longhorn Steakhouse surprised to the upside, but even that was only up by 60 basis points. Darden's overall sales came in a little weaker than expected, too, up 1%, mainly because they added 42 new restaurants. The company did put up some solid margins, but their earnings per share still came in 8 cents softer than anticipated off of a $1.83 basis. This was a true top and bottom line miss. Wall Street's initial gut reaction was similar to mine. Darden sold off big from 159 to 153 in pre-market trading. But then the stock quickly came roaring back, ultimately finishing the day up $13. How the heck did that happen? First, even though the quarter itself was not so hot, Darden stood by its full-year forecast for the 2025 fiscal year, and that forecast is pretty robust, assuming they can hit those numbers. Management clearly believes they can make up for this miss in the remaining 9 months of their fiscal year. That's very bullish. Second, on the conference call, Darden handled things incredibly well. Management didn't shy away from the fact that the results were disappointing. They also sounded confident that they know what they need to do in order to hit their targets. Third, with every quarter, Darden gives a forward-looking 6-month outlook for its commodity costs. And that outlook looks slightly better now than it did 3 months ago. Specifically, Darden's projecting less inflation for beef, for dairy, oil, produce, which happen to be their 3 biggest food expenses. Beef alone makes up a quarter of their commodity spending, and Darden's only expected to spend low single-digit beef inflation. That's down from mid-single-digit last quarter. The only quarter that's getting worse is seafood, but even there, they're expecting 0 seafood inflation over the next 6 months. Basically, the future looks better for Darden for the same reason that the Fed cut rates yesterday. We've done really well against inflation. We've whipped it into shape. Fourth, Darden announced a new delivery partnership with Uber Eats. This is what got most of the headlines. Darden's been reluctant to get into delivery, especially with third-party services. They were worried about disrupting the experience for both customers and employees. But after what seems like a very thoughtful negotiation process with Uber Eats, they decided to take the plunge, which is clearly a good idea, especially because, as you and I may know, the lines at the restaurants are just way too long. Now, this new partnership with Uber Eats will ramp slowly at first. Darden plans to roll it out first at only a few OG locations this quarter. Assuming the pilot program works, they'll do a phased rollout to all Olive Garden locations that currently offer curbside takeout. That should happen by next May. That's a nice innovation from what happened with COVID, if there's anything good that happened with COVID. So it's going to take a few quarters, but it's definitely a positive. Reminds me of when Domino's Pizza finally stopped trying to go it alone and agreed to partner with Uber a little over a year ago. Since then, the stock's up more than 17% thanks to accelerating revenue growth, although who can say how much came from Uber? Finally, and perhaps most importantly, even though the quarter itself was bad, what we call the cadence was good, meaning things got better from month to month to month. Specifically, Darden's played that after June was fine. Then July was real bad. But then things rebounded in August, and management added that same-store sales have been even better in September, meaning the current quarter is going real well. Now, I can't say Darden's rally today was all about his cadence commentary, or even mostly about it, because the conference call only started at 8:30 a.m., and the stock was already up substantially at that point. But I do think the cadence is the most important part of the story, because it cuts against the idea of a weaker consumer. What if the consumer is actually holding up okay, and July was just a weirdly bad month? Remember, Amazon, pretty good company, well, I think so, and knows a lot about consumer behavior, noted that they had some softer sales results in July. They blamed the first assassination attempt on former President Trump and the Olympics distracting people from shopping. If that's true for Amazon, hey, might it be true for Darden? Maybe all the hand-wringing about a tapped-out consumer turned out to be a tad excessive. Obviously, there are real pockets of weakness out there, especially among lower-income customers. We know that. But I think there's a strong possibility that these worries did get exaggerated somewhere along the way over the past couple of months. Like Jay Powell told us yesterday, the economy and the labor market, they're solid. No wonder we got a healthy retail sales number earlier this week, up 0.1% month over month, when Wall Street was looking for a 0.2% decline. The retail portion of earnings season last month went generally better than expected at the margins. Gasoline prices have come down about 28% from their April highs. That helps a lot, too. All this is before the Fed cut rate by 50 basis points yesterday, with the strong likelihood, frankly, of several more rate cuts to come. Lower rates will eventually breathe new life into the consumer. Which brings me to the bottom line. If the worries about the consumer are truly overblown, then there are many stocks that are worth owning here. Stocks like Darden Restaurant. Today, Darden reported a weak quarter, but still led the market higher. Some of the company specifics, like the Uber Eats deal, some of it's more general, like a better commodity inflation environment, or the cadence of the quarter that lines up with what we heard from Amazon. July was bad, but things bounced right back in August. I think we can take our cue from Darden itself here. And that's great for a whole host of retailers and restaurants with stocks that stagnated over the past year as the Fed kept things tight and confidence ebbed and then ebbed some more. Mad Money is back after the break.
Coming up, lightning doesn't just strike twice in Cramerica.
Booyah, Jimmy Chill. Booyah, booyah, booyah.
Thanks for taking my call.
It strikes every day. Cramer is back in a flash with your questions. Next.
It is time. It's time for the light round. Chris Berry, that's speaking about Trevor Lawrence. He's saying in the stock, I said bye. Shells was there. Stock comes at a time. My staff prepares to play. You're playing the sound. And then the lightning round is over. Are you ready, Ski Daddy? Time for the light round. Crimson Blade. Start with Suzanne in Pennsylvania. Suzanne.
Greetings from PA, Jim. My husband and I are club members. We love your show.
Oh, thank you so much. Thank you.
You're so welcome. Calling because we own Viking, and on September 9th, they announced that launch of the secondary public offering. Can you explain this, and if it means I should buy, sell, or hold Viking?
Look, you want to buy Viking. We're not going to care about the day-to-day of what stock is being offered. What matters, this is a really fine company, and it will do well for multiple years because they have many ships coming in. Buy Viking. Let's go to Rick in Indiana. Rick.
Booyah, Jim. First-time caller, long-time listener, club member.
Excellent.
And I love your
Thank you. Oh, thank you very much.
My question is on Gentex, GNTX.
Yeah, Gentex is too closely related to autos, and autos have been hurt so bad, and I don't see a quick turn. We're going to need several Fed rate cuts before they turn. I'm sorry. Let's go to Will in North Carolina. Will.
Booyah, Jim. You think
Booyah, Will.
More money with Jacksonville-based Cadre Holdings? Thanks, Jim.
You know what? It's a good, simple story. I like safety. I like survivability. There's always room for it. I think it's a good story. Let's go to Robert in Massachusetts. Robert.
Booyah, Jim.
Booyah, Robert.
Listener, first-time caller. Question is on Celsius Holdings. CELH.
Something's the matter with Celsius, okay? This stock was at 99, and now it's at 34, and we have not heard word from John Fieldly other than everything's great. That's no longer tolerable for me. I want to know what's wrong, not what is great. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Coming up, get to the Golden Gate. Cramer's deep dive into the heart of Silicon Valley continues.
It seems that every time Apple comes out with a new phone, it plays out the same way, and this time it's no different. We got some stories over the weekend that iPhone 16 pre-sales were weak. Before this phone was ever available, we were told that it just didn't have the pizzazz. It was another bust, a no-growth phone that would force Apple to admit it's become a no-growth company. I was suspicious. I was out there right here next to Apple's headquarters when the weekend bomb dropped. Still, there's no way to refute these negative stories in the moment because Apple's notorious for not revealing how sales are going until it's certain. Who can blame them? I mean, their job is to make unbelievably good products, right? Not temporarily protect their stock from the ever-circling jackals who always seem to want to bring it down. When I came in that morning, I saw Apple stock was off 3 points. It was the middle of the night, so I was going to go to X, formerly Twitter, and write to someone as a negative story about how Apple's only sold a select few phones, and the shorts will have a field day with this one. But of course, as is typical with hit jobs, I didn't have any ammo to stop it. So when my squawk on the street colleague, David Faber, asked me about the new report, I defaulted. I said this is the perfect use case for what I tell the CNBC Investing Club, that they should own Apple, not trade it. I said this kind of story, it just keeps happening, and it's an anticipated stampede out of the stock will occur simply because it can't be prevented. But if people could just wait, hey, maybe wait to hear Mike Sievert, the CEO of T-Mobile, because he's got better insight to iPhone sales than anybody, and we get that later in the week. I explained that even though I didn't think the negative story was made up, I don't. And it wasn't malicious. There's always someone with a small piece of the pre-order puzzle that can't resist blabbing about how they have the real story. They just had to make their splash, even if it misled people, even if it misled you. Sure enough, when I sat down with Mike after this analyst day yesterday and asked him about point blank whether iPhone 16 pre-sales were weak, he laughed. He said it was the opposite. He said they were strong, maybe even stronger than last. No, definitely stronger than last year was the way he put it. And it was terrific back-to-school holiday for them. I mean, incredible. I told him about the story that deemed the new phone dead on arrival, and he was incredulous that anyone could draw that conclusion. Again, T-Mobile would know. They subsidize these phones heavily in order to take share from AT&T and Verizon. If anything, he was surprised at how well they were selling. I shook my head. I mean, how about all these people who dumped Apple on Monday morning at $213, down almost 9 points from where it was trading before the weekend hit job? But there are no do-overs in this business. Those people are out of the stock, and here it is back up to $229. They lost out on 15 points because they gave up on Apple because of some silly story over the weekend. The answer, frankly, them's the breaks in the game. Unless you believe in Apple, unless you trust the company to put out a product you'd want, you shouldn't even own the stock in the first place. But if you believe in it enough to own it, then just do that. Don't try to trade in and out on every data point, including the wrong ones. Oh, one last thing. Sievert made another point. He suggested this might be a very elongated, successful iPhone launch because some will wait for the AI features that still aren't out yet before they buy. He said it's going to be a big one. Who do you trust? Some parts supplier, some survey taker, some pontificator, or perhaps the man who may control the single most iPhone orders in America? Simple. When in doubt, go with the reputable. Skip the anecdotal. And when it comes to Apple, it's almost never right to put too much weight on the minor data points. I'd like to say there's always a bull market somewhere. I promise, my friend, just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow from San Francisco.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.